What does the Federal Reserve's back-to-back 75 basis point interest hike mean to you? After the Federal Reserve's or the Fed's two-day meeting, they decided to increase the federal funds rate by 0.75 percentage points to mitigate inflation. We'll be talking more about the Fed and their efforts in managing inflation. We'll also get into how the federal fund rate affects you and what may come next for interest rates. Before we dive in further, Eggheads, hit that like button, subscribe, and click on that notification bell to get updates on our latest videos. The short-term borrowing rates have already been increased by 1.5 percentage points by the Fed. In a span of nearly 3 decades, we now mark the largest increase in the month of June 2022, where there was a 75 basis points increase. We can expect even more increases until inflation decreases. Consumers are taking a huge toll given the cost of living, while the increase in interest rates can either give the people opportunities or even more challenges depending really on what people do with it. So, how do federal fund rates affect you? The federal fund rate is determined by the U.S. Central Bank. It's the interest rate which banks follow when borrowing and loaning to one another. It isn't the interest rate that consumers pay, but it does affect the consumers because it affects the rates of borrowing and saving in the market. How can we understand this better? A rate hike will basically increase the prime rate, which then raises financing costs, which affects the borrowing of consumers. On the other hand, high interest rates will benefit savers because they'll have higher earnings from the money they deposit. The first to jump are short-term borrowing rates. Usually, rates of credit cards vary, and this has a direct association with the benchmark that the Fed sets. Like I previously mentioned, when there's an increase in federal funds rates, there's a domino effect in the prime rate, which also increases the credit card rates. The percentage rates at present are over 17% yearly, on average, but by the end of year 2022, it could also be a little close to 19%. If it does get close to 19%, then this would be the highest thus far. This will have a negative impact on people who have a balance on their credit cards since they'll be paying for more interest. What can you do about this? You'll have to start paying off as much debt as you have while the rates rise to avoid paying for more interest. If you're aware that you have a balance on your credit card, it's best that you call up your bank that issued your credit card and ask if you can get a lower rate. You can pay off first your high-interest credit cards, or you can just try switching to an interest-free balance transfer credit card if you can. Home equity lines and adjustable rate mortgages are tied to the prime rate, while 15 and 30-year mortgage rates are still at a fixed amount and are pegged to treasury yields as well as the economy. If you're someone who's looking into buying a new house, then you have lost a lot of purchasing power due to the rates being doubled. Auto loans are still fixed, but even then, car prices are increasing as well as the interest rates in new loans. So, if you've been thinking of getting a new car, you're going to need to put out more money. For federal student loan rates, these are also fixed, but most people who have existing loans won't be affected. Although, if you're just about to apply for a loan for money for your college tuition, the interest rates on student loans for 2022 to 2023 are already higher by 4.99% from 3.73% last year. A private loan can neither be fixed or vary in the rates. These are tied to LIBOR, prime or T-bill rates, so with the Fed rates rise, people borrowing money will probably need to pay more. The rise in the interest that they'll need to pay depends on the benchmark that's set. Now, for some good news, interest rates for savings accounts are higher, which means people who have savings accounts will be getting more returns from their deposits. Deposit rates aren't tied to the Fed, but they do change when the target federal funds rate changes. While the rates rise, the higher the yields. But it's important to note that if your money is earning less and can't keep up with the rate of inflation, then your money will eventually lose its purchasing power. Expect that interest rates will get even higher. Traders are presuming that the rates will get higher again in November and December, and it's possible that rates could fall during the spring, depending on the economic conditions. But what happens to stocks if the Fed raises the rates to 100 basis points? Stocks have been dragged to their lowest points in a day because of inflation. Inflation has remained steadfast in its increase, and investors are worried that we'll soon find ourselves in a recession if the Fed continues to increase interest rates. Wall Street experts are saying that it's highly likely that the Fed will increase the rates to 75 basis points, but more people are starting to presume that it will be raised to 100 basis points. Investors don't even consider the possibility of a 50 basis point rate hike anymore, given the rise in inflation rates. Traders say there's a 20% chance that the rates will be raised by the Fed even higher than 100 basis points. Even the Nomura Securities economists say that the Fed will raise the rates to 100 basis points after 50 basis point increases for November and December of 2022. If the Fed does raise it to 100 basis points, soon then, public concern will get even worse, since this would imply that the Fed isn't confident about their timetable, and this would result in us being in a recession. 4 decades ago, Paul Volcker raised the rates to 100 basis points. That was the last time the rates were raised this high. During that period, markets fell, stocks were declining, but after a 6-month mark, the markets leveled out. There were 7 instances when the rates were raised to 100 basis points, and 6 of these times, Volcker was responsible for. His endgame was to bring inflation down, and that's exactly what he did. He risked all that. The economy went into a recession, but soon enough, the economy was restored. Burns was the chairman of the Fed before Volcker. He was zigzagging between lowering and raising interest rates, which didn't do the economy any favors, and ultimately didn't solve anything, which is what the Fed wants to avoid. There may be similarities in the economy now to the economy during the Great Inflationary Period 40 years ago, but the economy is evidently stronger at present. This is thanks to the solid labor market and steady consumer spending. We still can't tell whether the Fed can give us a soft landing or will leave us in a recession, like what happened in the 1980s in Volcker's time. Retail sales are below expected, and weekly unemployment rates are also falling behind. Still, the economy is going steady for now. The question is, how long will this last? If the Fed will raise the rates to 100 basis points, the whole market will be thrown off, and there's going to be a lot of pressure on equities. What's our takeaway from today's video? The Fed increased the rates by 3/4 to manage the economy. This is resting in a higher cost of living, but the rise of interest rates bring about its own set of benefits and challenges. That's all for today, Eggheads. I hope we gave you a clear description of the Fed basis points. If you found this video useful, please subscribe, click the like button, and hit that notification bell to move further with each video towards being an egghead yourself. Catch you in the next video, aspiring eggheads.